Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial opinions, and make your own financial decisions. Today is Wednesday, September 21st, 2022, and this is Blockhead Traders Weekly. On this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a brief look at one of the plays that I put on very recently that I was able to close out for a profit. And we are then going to step into some crypto strategy where I and Viper really want to kind of go down this validation in the crypto world space, but it takes a lot of upfront capital. And we're going to talk about some ways that we're thinking of arriving at that necessary capital. But before we hop to that, I want to give a link to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, a few of the other Blockhead traders. Always a bunch of good discussions going on. Love to hear what you're trading. Stop in and say hello. You can also find each and every one of my trades at thetagang.com/sprocket888, where I post all of my equity options trades. You can see my successes and my failures. But let's hop to this week's content, Viper. So, Viper, this week I had a surprise move on one of my plays, and I took advantage and closed that play out. And I want to talk a little bit about it because it really highlights how much influence volatility has in the price of options. You hear us talk all the time on here about selling premiums, selling insurance. Do it when it's high. It's going to contract. There's going to be a reversion to the mean. And that's all well and good, but sometimes you really don't conceptualize how much of a driver that premium of volatility really can be. And so in last week's episode, we actually opened up a trade on this pharmaceutical company, VERU, and I'll pull up the trade play, and I actually added on to it a little bit as far as what the actual trade ended up being. And this had just crazy volatility, 300% volatility. It was in a 95th percentile of historical volatility. Like, this was the peak of peak can be volatility plays. And it was just super thick. The thing was trading at like 1550 when I opened up the trade. I was able to sell, 38 days to expiration, 1250 put for $3.80. And this past Monday, I glanced down at my portfolio and I saw that VERU was just up huge. Like, I was kind of treading water on just being even on the trade because the underlying had continued to fall throughout last week. But I glanced down and the trade was up like, 30% profit on there at that time. And I was like, what is going on? And I pulled up the ticker only to see that the volatility had just absolutely collapsed on the thing. So the particular strike that I was trading was down to 150% volatility, which is still high, but that's 50% less than where I started. And the price of the option was actually down, or not price of the option, price of the underlying was actually down 22%. So it was just this super bizarre situation where the underlying had fallen actually 25% from where I entered the trade. The option was actually in the money. So we were actually below my 1250 strike, and volatility had absolutely deflated. So the value of the option was very low, which is good for me because I sold it when that premium was high. And I was actually able to close it out that day, bought it back to close for $2.60, putting $1.20 right in my pocket. And you might think, well, $1.20, big deal. You sold it for $380. Why didn't you want to hang on? And really, this is a pharmaceutical. I wasn't super crazy about it anyway, but the volatility was just too juicy. And now that the volatility was gone, there really wasn't any more volatility to wait for contraction. It was more just looking for theta decay. I really don't like pharmaceuticals and how much they move around. And so I was happy to pack up my bags, book my $120 gain out of my $800 cost basis, which, by the way, was a 15% return on my capital in just 6 days. So just to visualize this, I'll just pull up the chart here real quick on the volatility collapse. And you can see right here, Monday, September 19th, just this massive drop off a cliff in volatility. And I checked the news feed. It ended up happening. I mentioned there was an FDA event coming up on October 6th. Well, news came out on the 19th there on Monday that FDA event was being pushed back a month and it was going to actually happen in November. So the uncertainty that was around this option that I sold, which expired in October, was kind of, no more uncertainty there. The FDA event wasn't going to occur till November. So volatility just absolutely deflated from there. And I was able to just ring the register on that. And it was probably one of the clearest definitions of how powerful volatility is in the pricing of options, to actually be down over 25% on the underlying, be in the money on your option trade, and still pull out that kind of profit from it.
Yeah, there's a couple things about this that I wanted to call out. So if we take a quick look at my chart, because even what you just said, as far as like it was down 24% when you closed, I was like, what the heck? Like how was volatility still way down? And the price had just moved 24%. Usually, like looking at the chart here, so you entered on this tick. This is the daily, and then you exited on this tick. Like this is the kind of move that you would expect volatility to increase on. It just kind of showcasing the bizarreness of this, but it's not super bizarre. Like we can explain this because if we look at how we got to the point where you sold, we did that on a 1 day thump. I don't have this marked, but it's about a 30% dive, and then a rebound of, just bouncing right back up that 30%. So I believe that the volatility when you got in here was so insanely high, primarily because this was a back-to-back. It was a day and then 3 days, but 3 big days. So you had this massive thump down and then massive climb back up. So it was kind of 2 major volatility motions that happened back to back that led you into this moment right here where it was like this thing's just super juiced. So I think that's the correct theory on volatility, that back-to-back motion would increase the volatility. But at least that's what makes sense to me as far as how we got to where you entered.
Yeah, no, I maybe that's it. I really have no idea. That's one mechanic that I would love to understand more, is what goes into that volatility calculation of the option chain.
Yeah,
because it absolutely evaporated on Monday, and I don't know why.
Yeah, and the last thing I wanted to call out about this was how good it is to get out of this. Like, I mean, we've talked so many times about pharma and just how surprisingly blistering pharma can be. I mean, even this chart, I think we talked about it when we looked at it. Like this, you look at this volume down here, and there's all. I mean, it's not insane volume, but historically, this is insane volume for this, which I think I mentioned on the show. Which to me scares the pants off of me to be naked any shares in this, trying to go long when you have this, this floor right here, where the volume came in and we established this floor. And that volume comes in because this is pharma, this is speculative, this is FDA approval pending, all that kind of stuff. So all this money comes in, creates this floor. The moment you get any sort of news about it not being approved, thump, the floor is gone, and we're way back down here. Which, if you didn't watch the episode, go back and watch it, because we talked about the break even, if, worst case scenario, all that kind of stuff. But yeah, this was fun. I mean, it was probably more fun to be in it, but it was also fun to watch from the sidelines.
Yeah, no, it was good. Like I said, no one gets in trouble for taking a profit. Maybe I left something on the table, maybe not. I'm happy to be out. I got green in my pocket and moving on to the next thing.
Yep.
So speaking of things next, Viper and I have long since kind of eyed different aspects of crypto. I know one of the things that really jumped out to me when Viper was kind of pulling me back into the crypto land and just teaching me all the different aspects of it and all that's changed from, my exposure like 20 years ago to Bitcoin mining. And the first thing that jumped out to me is the people that make the network go round are the validators, the miners, the people that are basically facilitating the transactions from occurring. And that's just a key pivotal role in the blockchain and in the ecosystem. And, I equated a lot to your credit card processors, the Visas, the MasterCards, where they charge some transaction fee to the merchants in order to process the transaction to make things easier on the consumer. They just carry around some plastic and they can buy anything. They're very low fees relative to the grand scheme of things, but they do thousands, tens of thousands, millions of these transactions. It all adds up. And in crypto land, that is really where your gas fees kind of come in. And each chain, handles gas fees a little bit differently. They distribute things to the miners, the validators a little bit differently. But at the end of the day, it's those people that are facilitating the network. And so no matter whether or not crypto is going up or down, left or right, those validators are processing transactions. And if there is a transaction fee to be gathered, the health of a particular cryptocurrency doesn't matter as much as long as people are using it. And this has been a goal of mine to drive towards that capability. Initially on, it was, I want to be a miner. I want to have this hardware. I want to be able to run this. But more and more chains are transitioning to what's known as proof of stake from proof of work. And proof of work was really the older school method where you churn compute, you burn electricity, your skin in the game is the hardware you invested in, the time to run the calculations, that was your skin in the game. Now, as we move to a proof of stake, these chains, the most recent one was the Ethereum merge that just happened a week ago, where the Ethereum 2.0 is now a proof of stake. So to become a validator, you don't need all that compute power anymore. You basically just pony up a large sum of the cryptocurrency in what's effectively an escrow account that says, hey, here's my skin in the game. If I don't do a good job validating, go ahead and take this cryptocurrency away from me. And that stake is set such that it is a substantial amount of money to pony up and to lose. So, you're incentivized not to screw up. And Viper and I are really into the Avalanche chain, which is, AVAX currency. We participate in some of the activities on there. It has some unique characteristics that both Viper and I feel have it positioned pretty well to be around for a while. And it's a goal of mine to basically become an AVAX validating node. Unfortunately, you need 2,000 AVAX at this present time to become a validating node. Well, yes, AVAX is at all-time lows, but 2,000 AVAX is still a substantial amount of AVAX. Viper, do you have 2,000 AVAX sitting around?
I wish we wouldn't be having this conversation. We'd be showing you what a validator looks like.
Yeah, that's true.
But yeah, like I do not have it sitting around. But I feel like we're in a very unique seize the day type of moment. With that, like everything you just said about being a validator, having that recurring revenue stream and it's the kind of revenue stream that it's understandable. Like that's one thing that is a huge lesson that needs to be taken from the world of crypto is everybody in crypto says free money, get this free money, get this crazy, return on investment and all this other stuff. And it's all, a lot of it is not based on anything substantial or sustainable. But the value in a validator node is very clear. You are helping to secure and process the transactions on the network. So the couple of merging of events that I wanted to call out real quick was if we just real quick look at the AVAX chart, because like Sprocket said, we are near all-time lows. We're down at $16.50 from this last crypto run, having hit all the way up to $150 just about. And so, I mean, yeah, like 2,000 AVAX at $100, like forget about it. $200,000 to do this, because one of your biggest, if not, so you have two massive risks that you need to be a validator. One is the network needs to be around. It needs to be used. It needs to be, processing things and have a use case. And the only thing I want to touch on that is we're getting into what I will call crypto regulation season, and we have seen lots and lots of signaling from the U.S. government that they do not want to outright ban this thing. They want to find a way to come alongside crypto, regulate it, and start to develop it in a way that merges in with the financial system. That is going to involve a lot of regulations. And so we can get into the specifics of the Avalanche network if anybody's interested, but suffice it to say, there is a lot of unique characteristics to this chain that lead it to be very friendly to those types of regulations that will happen. So that checks a huge box on my list. Is you need to be around for a long time, and if you're going to be around, you need to be very regulation friendly. The second thing is that cost. Like I said, at $100, forget it. Like, I mean, ponying up $200,000 just. I guess it's all relative to people, but to me, that's way out of reach. And so the risk is that you do, if you did jump into a validator at $100, you're locking that up to be this validator. And so this big, anybody that locked up at $100 here, and then this crash happened, they couldn't unlock that. They just sat there and watched their value devalue and crash down. So that's the second big risk, is the value of the underlying while you're locked up. And so to me, this is also presenting a decent opportunity. First of all, that not by myself, but 2,000 AVAX at $16.50 seems a little more reachable than at $100. And the thesis of price action, and okay, so from $16, where to then? Yes, everything can go to zero. So this can still go to zero. This can still drop 50%, 80%, whatever. But to me, being at the bottom is a much better probability of entry, that if I had those 2,000 AVAX today, lock it up and, for a year, and where's the price in a year? Not zero is possible, but the probability in our favor is that something we always talk about. The probability is at some point that value is going to increase, and therefore that it doesn't fully mitigate, but it's a consideration for that second major risk that I see.
Yeah, and not to mention, you don't validate for free. It's not about just locking up your 2,000 tokens and that's it. There are rewards for validators, and you do get to collect those rewards. Otherwise, there's no incentive to be a validator, and we wouldn't have validators. And without validators, you don't have an active blockchain. You don't have an active blockchain, you have a dead currency.
Yep. And so that's a good point. So let's take a quick look at that. What's your incentive to do this? I mean, those were two major risks that I outlined. So what's your incentive here? Well, your incentive is a interest rate for staking that up. And the way the Avalanche network works is new AVAX tokens are minted, and they are minted directly to the validators. And then the validators are the way that token enters supply. And so you can see here currently the average for this so far this year is 8.94%. This does fluctuate slightly. This is on the lower side of what we've seen. It's has recently gone up to 11%. But this is the main motivation here, is if you are long on the network, long on the token, and you lock it up for this 8.94%, you can see here, if we did 2,000 tokens, we're getting 178.86 at these current rates. And at the current value, that's $2,900. Obviously that will fluctuate significantly with, the price of the token, but this is the main motivation for doing this and helping out, is you're getting the return and your value in that is that you're getting those newly minted tokens, and that's how the currency enters supply. So this is being in the critical position of utility. The fact that these tokens are entering supply through you onto the rest of the ecosystem.
Yeah, one thing I call out here, because I looked at various networks as far as becoming a validator, because that was something I really wanted to drive towards. In fact, I started trying to pool money to become an Ethereum validator. I've kind of abandoned some of those hopes and started moving to the AVAX camp. But one interesting thing, it says right there on the screen there, no slashing. And this is something that most of the proof of stake blockchains actually do, where you need to be incentivized to always have your node up and running and processing transactions. And so what they do is they monitor that, and in many blockchains, when you fall below a certain threshold, that pool of money that you put up, they'll take things from it. And they'll say, well, you weren't online for this time, so we're docking you this, and they will pull some of the cryptocurrency out of there. The way that AVAX does it is you do have to have a minimum uptime. You do have to have availability. The difference is if you fail to meet that, they don't take your initial stake away. They don't pull things from it. That's what the slashing is. They just don't reward you. And so whatever period you're in there, if you ever fall below your threshold, all your rewards for that period are gone. You just don't get them. And so you're incentivized not to screw up, because otherwise then you did exactly what I said no one wants to do, and that is stake for free. So that's the incentive is kind of nice because you are a little bit protected from that initial pool that you put up. You're guaranteed not to ever have less AVAX than when you started. No guarantee to what the value of that AVAX is, but you'll still have that full amount.
Yeah. And the last thing is the idea of this delegation. So if we had a validator node that we got it up and running, we could actually have up to 2 million AVAX tokens, what's called delegated to our node. And so what that is basically anybody that wants some sort of piece of this pie to build up their supply, but they don't have 2,000 yet. So they say maybe they have 100, maybe they have 50, whatever. You can take your tokens and you can delegate them towards a stake on a validator, and you get a portion of that validator's rewards. Whoever's running the validator gets to charge you a fee, which is currently 2%, and they get to keep that fee. And so instead of this 8.94%, if I had 50 tokens and I was delegating them to Sprocket's validator, he would be getting 8.94%. I would be getting 6.94%, and he would be getting my 2% fee that he charged me for letting me get that 6.94%. And so that becomes very enticing as far as potential for generating that income, because it's not just 8.94% on our 2,000 that created the validator. There's all of these delegators, and there are a lot of people delegating. Again, stuff we can get into in another video. You can observe current delegations and where they're being assigned, and many validators are actually near maxed out, or at least have a significant delegation assigned to them, as long as they're online and responsive. That is another factor, is if you're not online, not only are you not getting your rewards, but people are not going to delegate to your validator node. But now we're going all the way back to the initial problem. I do not have 2,000 AVAX. Sprocket does not have 2,000 AVAX. So, in real life, we're very trusting of each other, and so we would just, okay, well, let me just send you whatever we need, or let's pool together and figure this thing out. But that's not, doesn't have to be the case. It's you should trust whoever you're grouping together with. And so let's even start to think a little bigger picture, like not so focused on the validators. Validator is our use case of, it's a large investment that needs to be pooled together. But there's lots of other things that you've maybe wanted to be able to pool together to be able to invest in, and there's not really a good mechanism to do that in a trustless way where you simply have a shared stake in something. And that's one thing that from the very beginning in crypto has always fascinated me is the concept of a DAO, a decentralized autonomous organization, which is a fancy way to say a coding contract between people of saying, here's a pool of assets and I have X percent and this person has X percent and this person has X percent. And it's all trusted because it's in the code that's how it is. It's hard coded. There is no like paper ledger of like, oh, okay, well, let's check the sheet and then I have to trust you to pay me my share or whatever. And so what's always fascinated me is that concept of being able to do that in a, we'll call it Web3 blockchain space where you can have those coded contracts. Unfortunately, I'm sure anybody who's even remotely followed crypto has heard the name DAO in the news. There is just a lot of exploitation around the concept. But there is now a protocol that's being developed that I found that lets you create your own personal DAO. And it's intended to be a small group of people that want to come together to invest in something bigger than any one of them can afford, but also do it in a way that everybody has their own fair stake in the game, and they can retract it. They can, get rewarded equivalent or, per the ratio of who owns what. And so that really struck my interest as to how that could apply to our situation, but also in general, taking this concept to a more personal level of, in this case, up to 12 people. And so I mentioned it to Sprocket and said, hey, well, what say you on this idea? So I don't know what kind of thoughts, interested you in it or concern you still that we need to see vetted out.
Yeah. So conceptually, we're going to touch on it a little bit more, but whether or not it's your neighbor, your brother, your best friend, or a complete stranger, everybody always has good intentions when you have the handshake agreement, things like that. And really, nothing, I have realtor friends, right? And one of their rules, a lot of them are, I will never help buy a house or sell a house for a friend. Because when you start involving money and transaction, like that just hits people in weird ways. And so for me, yeah, I want to become a validator and it'd be cool to pool resources to achieve that. But I really want some sort of contractual protection that basically says, look, this is what we agreed to, and we're not going to change our minds type of approach to things where you can kind of get into with those handshake agreements. And so, Viper came to me and says, well, I got this project I heard about, and, we're going to talk a little bit about it here. And what I like about it is it provides that kind of contractual protection, smart contract. That's the buzzword that people throw around, but it's coded in there. This is how this thing works. This is what's going to happen. Do you agree? Sign on the dotted line. You're in. And so that approach, I think, is very prudent just to maintain a good and healthy expectations for a joint engagement, such as pooling for a validator or pooling for any sort of resources.
So since I clearly don't have those funds myself and I need this idea of pooling together, there is this project which I've been closely following and involved with, kind of chatting with the developers a little bit and helping them develop what they're offering here with just my use case ideas and things like that. It is this protocol called Forum. As you can see here, invest with friends and share the burden of investment research, spread the cost of expensive assets, and reap the rewards together. And so basically what happens here is this all, you share a link. One person sets up the group, and then you share the link with up to 12 or up to 11 other people. So you can have 12 people max in the group. And basically this is a way to contract together your funds. And so basically you would create a fundraiser and say, maybe this one thing we want to buy is X amount of AVAX tokens, or you just say, we want to create a pool of X AVAX tokens, and then we'll figure out what we want to spend it on later. You would create the fundraiser. People could contribute whatever they want, whatever they can afford towards that fundraiser. and whatever percentage of the total treasury they deposit, they receive that percentage of a valueless token that represents their share of the pot. And that's important because that goes to the whole trustless aspect of this. Now, I don't plan to ever be in a group that I don't know everybody in the group. I mean, that's just, where I think a lot is safe to be at with this new frontier of trustlessness. But this is the one thing that's fascinated me with Web3 development and, the use case of a blockchain DAO, is this idea that you have a share of a treasury and no one person is in control of that. A coded contract is in control of that. And so on this protocol, you would basically then, pool those funds together. There's a voting process. There's a proposal process. So say Sprocket and I pool our money together and I say, hey, here's this thing. I think we should buy this. I think we should invest in this or whatever. That's all well and good. Nobody's allowed to spend the wallet's money without everybody agreeing in a vote to spend the money. And so that's, again, that power coming through of nobody has individual control. You set the tolerance of how many votes are required to pass, whether it's 51% or you could go all the way to 100%. Like, we need to absolute unity on this. You could set how many people need to show up to the vote. And down the line, you can even delegate your vote. So if there is a group of 12 people, maybe one person's like, hey, I'm on vacation, but I trust Sprocket. He's going to vote in my best interest. So while I'm on vacation, I don't want to slow anything down. I'm going to delegate my vote to him, and he will vote for me in order to maintain the rules of the group and whatnot. So it's, in general, just a very neat use case, pure utility use case of the blockchain, which is what really appeals to me. Yes, we're using it for financial means, but it's not like, hey, here's a token and go stake this here and buy this here. Like, it's a tool. And I think those are always fascinating to me. And in this space of Web3, even more so.
Yeah, I'm excited to try it out here as we kind of approach. I know it's a real young project, really, and it's kind of almost beta phases of things. But it bears a lot of liking to the older school investment clubs of the past, right? Where you'd have a group of community members that would get together and they would all chip in different amounts of money to a common portfolio, and you would meet together and you would, debate about where to invest money. You would then talk about, technical analysis, fundamental analysis, and it was a way for people to get together and then have this shared interest of participation in a shared portfolio. This is kind of an evolution of that in the crypto space, and I'm excited to kind of see how it kind of plays out to allow for some contractual protections against the assets that are in this group wallet, and how it controls the delegation of what do we do with the group wallet, how do we spend it, the voting mechanisms and everything. It's pretty cool. So we're gonna dig into that here, and Viper and I are gonna probably participate and kick it off, and who knows where it'll go from there. But rumor has it might be a Blockhead Trader group wallet.
There definitely may be somewhere along the way.
So that brings us to the end of this week's episode. Just super excited to kind of share that power of volatility early on with that VERU play. I hope that really can kind of cement in your mind how important volatility is when it comes to an option price. When you're selling them, that's super great to sell at the high. But, for those people that are, don't like that idea and they want to constantly buy call options or things like that when volatility is just super high because it might bring them a big payday, just keep in mind, you're paying a lot of money for that premium in that option, which could evaporate into nothing if you're buying those options. Anyway, very interesting how much that particular play, the underlying, where is able to fall yet still be very green on the profit of the option trade. Then really awesome hopping into the how the heck did Viper and I reach that 2000 AVAX goal. This forum project that Viper has found and we're kind of experimenting with might offer some capability for us to pool our resources together to maybe someday bring up a validator with a joint of 2000 AVAX. Like I said, we're both pretty far from that, but we're going to experiment with that in the meantime and pool some of the resources, decide where can we go put these resources to work while we try to grow them into that 2000 AVAX delegate pool, so that one day we do have enough to run an AVAX validator node, as that really is the future of crypto. That is the oil in the engine that's going to keep it running, those validators out there. And so when you have the chance to become one of those important cogs in a machine that is going to pay you and reward you, to me, that is just something that makes sense to get into and go for. Aside from that, things are pretty wild in the market. Fed raised interest rates another 0.75% today. You can expect volatility to continue. You can expect debates on recession or not recession to continue. So just have fun out there in the market. A lot of good opportunities arising. Also a lot of dangerous opportunities arising. So be safe out there, have fun, and remember, think outside the block.